Welcome and thanks for watching this video. I'm Ross Bramwell, a member of Hamrick investment team. The markets breathed a sigh of relief the morning after the election, as there was no uncertainty about the outcome for the White House and the Senate. Although there are still a few uncalled seats left in the House of Representatives, the Republicans have secured a majority with at least 218 seats. However, markets have been choppy since those initial first few days, as now investors must evaluate what a red sweep could mean for the economy and stock and bond markets. In this video, we'll discuss our thoughts on what impact the elections could have and what we'll be monitoring for the next several quarters. For those contemplating what a red sweep could mean, first, it's important to remember that while policy can impact portfolios, it is not the only deciding factor for how things play out in the markets. We saw this firsthand under President Trump's first administration. Even with pro-energy and pro-deregulation policies, the energy and financial sectors were the worst two performing stock sectors for his 4 years in office. The S&P 500 Energy Index was down 40% under Trump, while the S&P 500 Global Clean Energy Index was up 275%. On the other hand, Biden campaigned on scaling back fossil fuels and pushing renewables and successfully passing the Inflation Reduction Act. Yet the S&P 500 Energy Index has more than doubled, and the S&P 500 Global Clean Energy Index is down over 50% during Biden's term. We believe macro forces, including changing supply and demand and Fed interest rate policy, ultimately drive shorter-term rates or short-term moves in the markets and have mattered more than any policies or intentions by the president in recent years. Politics is just one piece of the large puzzle that impacts corporate earnings, which we believe ultimately drive longer-term returns in the broader stock market. There are lots of promises out there right now that could impact earnings, but nothing is guaranteed going forward since the legislative process can take a long time. While presidential elections are consequential for their influence on the trajectory of policy, equity market returns through various presidential terms tend to be positive and ultimately driven by the macro environment. As an example, despite two very different administrations under Obama from 09 to 17 and then Trump 17 to 21, market performance was nearly identical. The S&P 500 returned an average of 16.3% and 16% under each administration respectively. It is true that the administration will have control in Congress and also a strong economic backdrop to start. New unemployment claims are at recent lows. The unemployment rate has recently declined and is still at historically low levels of just above 4%. The consumer is still spending, and that is driving solid earnings, and GDP is at levels considered above trend growth. So let's consider what this could mean for different asset classes. Here are some of the key takeaways. A Republican-controlled Congress, it increases the potential for significant policy changes, including tax cuts, deregulation, and higher tariffs. However, the size of the majority in the Senate and also the House will be key, as well as Trump's own priorities once he's in office and is no longer campaigning. Overall, we believe U.S. equities, they remain supported, particularly on the back of growth and broadening earnings. However, there are risks rising around higher longer-term yields and tariff implications that do not seem to be reflected in the current stock market valuations and could ultimately lead to uncertainty ahead. We will have to watch the balance between pro-growth policies that can accelerate earnings but can also increase the deficit, along with the potential consequences of inflationary pressures from broad tariffs and a tighter labor market due to changed immigration policies. Although the Fed is still in a cutting cycle, bond yields are likely to remain volatile and higher than anticipated on the back of deficit concerns. The pace of rate cuts is likely to slow. And although we have the election outcome, we still lack clarity on many policies, which is needed to determine investment implications. Actual policy action often differs from campaign promises. So what we want to exercise is caution against chasing recent market moves, and we want to focus on what we do have clarity on. Let's take a look at stocks. Before the election, the backdrop was already positive for stocks. The immediate market reaction tells us that the market is re-rating future growth prospects higher. Looking at potential policy, one likely impact for stocks will be a more friendly antitrust regulatory backdrop, which will likely encourage M&A activity, that's mergers and acquisitions, which tends to be positive for the stock market and lead to higher valuations. This could happen across the banking sector, within tech certainly, and also healthcare. Antitrust enforcement also seems less feared than under a Harris administration. Tariffs at this point, however, are a little bit of a wild card. We know that it's likely that tariffs will be implemented, but we do not have a lot of clarity on the targets, which countries, or at what levels. This is something markets will have to address likely by early next year if a plan is laid out. We expect tariffs to increase on Chinese goods, but whether there are increased tariffs with European markets or Mexico is unknown and would have a much broader impact and would likely dampen growth more than just targeted tariffs on China. Regardless, we expect the onshoring of companies and diversifying of supply chains to continue. Broad-based tariffs could certainly benefit domestic producers, which tend to be more in the small cap space, over large multinational businesses, which tend to be in the large cap space. Tariffs, they're expected to be inflationary, as the tariff cost to companies will typically flow through to the price of goods. This could lead to higher revenues as the cost is passed on, but also can be a hit to margins in the short term. Stocks can offer a hedge against inflation, and we've seen this over the last 2 years. So we are looking to maintain our stock exposure as long as economic conditions do not deteriorate. We also note that tariffs are typically a one-time step up in cost versus inflation, which is a continual increase in prices over the years. So the cautionary tale is that stocks, they were already expensive before this move, with trailing price to earning ratios around 24 and the forward price to earning ratio, the PE ratio, around 22. While valuations may not be a great indicator of stock performance in the short term, it does highlight how much good news is priced into the stock market right now. Any stumble in economic data or a surprise Fed move or a decline in earnings guidance could quickly lead to a market reversal. Now let's look at the potential impact on bonds. As the bond market has been telling investors pretty emphatically in recent weeks, a Trump administration is likely to bring higher long-term yields. And there's a few reasons for this. One is positive, that with recent positive economic surprises and with higher expected growth, it makes sense that yields are moving higher as well. Second, although it was expected with both candidates, a Trump administration is likely to not going to rein in deficit spending, and current estimates expect deficits to continue to grow at a pretty rapid pace. Third, as both of the above are generally inflationary, the Fed may not be able to cut rates as was expected when the first rate cut happened in September. Expectations have already slowed for the amount of rate cuts in 2025. Both the number of cuts coming and the pace will likely change, moving to a fewer number of cuts at a slower pace. This leaves rates higher for longer, although they're still expected to be in a downward trend. As for this impact, though, it's likely going to lead to higher yields, which means lower bond prices and negative unrealized returns in the short term. We've already seen a significant move in the 10-year Treasury yield, upwards of almost 0.8% since the low a couple months ago. The main question for investors will be at what levels will it make sense to lock in higher yields? But we think we need more clarity on the impact of potential policies to make a determination. Right now, we still think it makes sense to have an allocation to shorter term bonds or a lower duration until we're getting paid to take on additional duration risk. So a Trump win is likely supportive of a steepening yield curve. Trump has historically been a firm believer in the Fed keeping short-term interest rates at accommodative levels, even though some of his policies are likely to put upward pressure on GDP growth and inflation, leading to higher longer-term rates. Let's move past stocks and bonds and take a look at the potential impact on real estate. Economic growth is crucial for real estate markets to drive demand and to absorb the tremendous new supply of apartments and industrial properties, as an example, that we've had in recent years. Broad and robust growth should help real estate markets. But the main issue for current operators of real estate is that debt markets and the skyrocketing carrying cost of higher interest rates and construction leasing costs, they're still continuing to rise. While we've seen a slight uptick in transactions, it's still very challenging to secure new financing or to refinance your current loan. And the level of debt proceeds is still dramatically lower than it was before yields spiked. Opportunities and these outcomes, they're going to continue to be binary, often dependent on the debt situation of an individual property. Although we're seeing an increase in foreclosures by lenders in recent months, a vast majority of lenders are still trying to extend a current borrower until things improve for a possible exit, which would include a borrower refinance or selling the property. Given that rates are likely to remain higher than expected than just a few months ago, they could extend the current challenging backdrop for real estate and extend the time until there is a true distress cycle or more operators are forced to exit one way or another. One of the reasons for the lack of transactions is a gap between what an owner is willing to sell at and the price that will attract a buyer. With extending still an option for many borrowers, they're holding out hope that rates will drop. Rates will continue to decline as the Fed cuts, but it's not happening as fast as hoped. So the markets they're not thawing as many as had expected. Higher rates under a Trump administration may slow that thaw at least through 2025. But one area that will likely benefit is the industrial space, as we've talked about, as onshoring and manufacturing and supply chains will likely continue to accelerate diversifying and coming back to the U.S., especially if additional tariffs are implemented. This could create more demand for manufacturing, logistics, R&D, and warehousing in port locations and infill suburban areas where the workers are located. Now let's wrap up with a few comments on private debt and private equity. For private debt, it's still a good environment. We continue to have strong economic backdrop and good fundamentals, and we have not seen a pickup in defaults, which indicates steady cash flow for investors. Floating rates will come down as the Fed is able to cut, but they're still able to achieve a nice spread over traditional fixed income yields. And Trump's pro-America platform is likely supportive of the smaller domestic-oriented businesses that are creditors in middle market lending portfolios. And on the private equity side, private equity will likely have a stable outlook, a more stable outlook, given that the more aggressive tax measures of taxing unrealized gains or carried interest being treated as ordinary income are less likely to be pushed forward under the new administration. And similar to what we mentioned for public stocks, it's going to be a more favorable backdrop for M&A activity, which should lead to increased activity in private equity. And then for the passage, if there were a passage of a Republican proposed 15% corporate tax rate, this would also increase profitability of private companies and be favorable to the industry. Thanks again for watching this video. If you have any further questions, please reach out to a member of your client service team.